Right, so at least on the weekly time frame, we should be looking for, just hide this, um, previous week, clear the previous week low and traded into this weekly imbalance. Um, I mean, there was just a shitload of volatility last week, so we trade back down to the weekly imbalance, hit the propulsion block here as well, and we got this strong move higher. So the week has closed like this on pound USD, and we're kind of stuck between 2 points, but because we made this inversion here on the week of 3rd of March, and then we did have at least 4 weeks of, let's say 3 weeks of consolidation. Then we traded past this high and traded into this inefficiency. So what I'd be looking for pound USD this upcoming week is, you know, ideally this previous week high initially. I want to see it get yeah, price needs to first trade up here, and then once we see that level, then get taken out, which is, I mean, it's quite the move. It's 131 points. Then maybe shorts back down into a premium, or we could see ourselves if we close past this high and then this inefficiency, then I see price reaching into the September 2024 highs, way above here. In terms of the short term, though, because of the size of this wick, could again run the high before trading back lower and using it as a discount wick. That's at least the daily time frame. Well, I guess the weekly. The daily did make an inversion fair value up here on Friday. So you see here, right? Clean besides Monday. 4 bullish days all consecutively. Um, yeah, so this rejection here could see then price move back lower and try and maybe retest this daily inversion fair value gap that it's made. Well, it's actually made a bullish BPR here on the daily. So yeah, so probably likely that then this gap here remains filled and price just runs up higher into the previous week high. I mean, which if it does, I mean, if we look at Friday's range, Friday we got a 170 points. If we look at Thursday, 193, Wednesday, 119. I'm just talking about total daily range. I'm not sure if these indicators are still here. I used it years ago. It's called the, I don't want this convergence shit. It's called the ADR, I think. Average day range. Sure. Fantastic. I don't want that. I mean, you notice how it was extremely stagnant. Wasn't really large range days at all, and then post tariff news gets announced, and you get this massive push higher. So the first key levels, which are to be noted then for pound USD, would be you see this thing's plugged in and just starts fucking up. I don't even know why I got this ADR. I forgot how to even use it. I just wanted to put emphasis on how you have extremely volatile and liquid markets that are to be taken advantage of. So initial level is this previous week high of the 320.74. So right here, key weekly levels for GU. It's the 320.74. That's the initial draw. However, move lower is expected. So, I mean, if Monday things like you need at least at 6 o'clock, and or at least in Asian session, you want to see it maybe then move lower and set itself up for tomorrow. Um, Also slightly unlikely, and then you've got this 4 hour here as well where we failed to make the inversion here. We simply traded up to that high, and then we've come back down into this inversion, which we've also respected its low, as well as this 4 hour fair value gap. So um, again, you could see price maybe want to reach back down into this low here, into this Friday 5 a.m. low. But yeah, that's all to be monitored when the time comes. I mean, if you just look at, I mean, the 4 hour says enough, really. You look at March, it's just not really, getting any massive moves. It's a very, very slow month. And then April comes along and it's just these parabolic swings. I mean, fucking hell, man. Look at this run up. I mean, how many points is this total here? This 280 pips. Get a massive fall of over 400 pips. And then you get a massive push again. I mean, the world might be going to shit, but I think as a trader, I'm pretty happy. This is very good, very nice. So, as well as here, see once this inversion got made here, so you see with the Tuesday 8th of April, the 5 p.m. 4 hour candle, after it made the inversion, then the next target becomes this high. But to expect the market to immediately pull there is to be naive. So instead, say on Wednesday, when getting all this, I guess, bearish price action here, all I should be thinking to myself is ignore the shorts, wait for the long. Because longs from here in the PM session held out would have been fantastic. I mean, I'm sure the model can even be found on, say, the 3 minutes we're looking at Wednesday at 1. Let's do that there. Wednesday, 1300 hours. There we go. You see, run lower, we clear sell side. Big move up, no inversions. We create a fair value gap here. But we do, when you create this one and we trade back down into it, there was no market structure shift yet. So this candle then runs higher. This is essentially a Venom sell model here because we failed to close past these highs. But remember, we're still bullish. Market dumps back down, clears that low as well. Then we get, what do you want, Charlie? You've been fed. How much fucking food do you want in a day? Oh, what an asshole forecast. Anywho, we get a propulsion block here after this candle's close. Well, actually, wait. What is this open here? This open is 27.61. This close is 27.629. So no, nothing here. You get your propulsion block. You have your inversion here. And then only returns into the inversion. Continues higher. Big drop at the start of the new hourly candle. Run back lower. Would have squeezed out anyone who'd been long initially. Come back down, create a propulsion block over here, and within the same candle, it creates an inversion. So there's the buy model. So how I think I would have done this, just because I think I've become a lot better at adopting, I'd say, a style that works, is being afraid to take the first entry makes absolutely no sense because the majority of the trades that are profitable for me, it's usually a second, sometimes even a third entry. Because what will happen is, for example, here, I fuck off, man. You're putting hair on my shit. No, stop it, Charlie. Fucking hell, dude. I swear the cats are attention whores, bro. I'm wearing black. Fuck. Kamatona. No. Stop it. You puss. So initial entry would have possibly been when you say hello, hello, hello. Stop it. Stop it. Fuck. Initial entry would have been maybe if you take this, if you, well, if I'd noticed the inversion here, um, so you trade back down. Obviously, no one is getting in at the wick, so you wanted to get in at the high, and for fuck's sake, what the hell did I do now? Okay, and because there's a fair value gap created here, so I think the initial stop, would have it would have been quite audacious. I mean, that's 31 pips. I don't do 35 stops. It's ridiculous. It would have been at the low end of the fair value gap because, say, after this candle close and you get this busy here, because the second candle made an inversion, it's extremely common that this then gets treated as a breakaway gap until this high gets traded to. So the most recent high before the SIBI turned inversion here. Um, so say then that's the first stop, right? And I would have been up already, say the 1.5 hour target, which is there. Fantastic. So I would have hit the 1.5 hour, closed, collapsed, say 2/3 of the trade, stop loss moves to break even there. The market runs down, would have stopped me at break even, which is fine because I'm still profitable. Um, yes, yes. Oh, just send to the fucking back. Why is it just? Anywho, um, you get a sweep here again. So because the market fails to close past this low and there's an inefficiency form before, there's the initial sign of there being a venom model. So that's a low risk entry right there. But I'm not at the point of where I'm doing these low risk entries now. I haven't studied it enough to have the faith behind it. Prop block inversion here. That's bread and butter. And so that would have been then the second entry. Could choose to put stops below this low because it's the most recent low before price close past this inversion. But I've seen it one too many times that the market just runs lower to sweep it here again before continuing higher. So it's always a safe alternative to rather put the stop loss here. Opens up a bit more risk, but so be it. So, anyways, that would be the first target. Once that gets traded to, again, 2/3 get collapsed and it stops to break even. And in this case, a runner up into the 4 hour buy side over here would have made for, I mean, look, the runner would have done some sort of damage. I mean, yeah, I think it's fair. Additionally, what I was thinking about is that, even just based on how this morning with the synthetic indices went was Say instead of closing, say at these points here, instead of collapsing 2/3 and giving the stop loss to break even, maybe only the stop loss goes to break even. And then you maybe say target of 1, 2, 3, or whatever. But if I just stop this off, and obviously, like, so it's kind of a double-edged sword, because now what you're really then fighting against and what you're competing against is you always run the risk of it, taking the high first, then returning, stopping you out, and then running high. It's happened to me this week as well. But I think, yeah, I'd stick with the closing 2/3 at 1.5. Leave the runner. I mean, when the capital becomes more and there's more to play with, I think, and I'm not looking for you know consistent returns like that. Then yeah, I think then it's fair then to accept what do you call it? Then I can let it run a bit more because I mean, again, so let's do this, right? So if we were doing the math here, if this, let's say here, this initial trade here, right, you're expecting a breakaway cup, and it gives you your 1.5 or you got say $5 of risk on, um, and you've made your 1.5, so you've made $7.50, and you choose to collapse 2/3, so then you've collapsed 5. So you literally are doing 1-to-1 guaranteed, and then your runner, you hope that that one then goes to do something better. Or to maximize returns, it's you. I don't know. I'm contemplating it so much because it makes sense. I just don't want it to make sense. Or say on something like this, you rather, again, once this high gets traded to, it's non-negotiable how it, the man and how it does it. Once that high gets traded to, stops the break even, you leave it. Then when it gets to about, say, 2R, then you close at 2/3. Because I mean, man, 1 hour is not going to do much. Because in this case, let's say I was expecting, I was being greedy, let's say I wanted 3R. It's break even here. Fine, I would have been up a maximum of 1.9, just shy of literally just 2R. Then I would have been hit for break even, which is fine. Because in the same logic, if I used it here, boom, right there, with if you take this wick right there, well, firstly, your first telltale signs of, say, market going, against you, which can help you, would say, if it was a trade against me, where you can get a chance to say close half or close a third, would be if this propulsion block here, if that leg gets closed fast. I mean, that's literally you taking your risk from 28 pips to 16. That's almost halving your risk. But obviously, you can't put a hard stop loss there because there can be a quick wick that just runs below and the body closes here. It's happened. It's happened multiple times. So, for example, here could have been that entry, that stop. Cool. That's the initial target 1.68. So maybe once 1.68 gets hit, you're like, cool. Stops are going to break even, and now you leave it. Because once that stop gets rolled, then I guess in this case, call it luck or sheer dumb luck or whatever the fuck. That was that's 3R. It's a very dirty 3R because it takes literally goes from New York PM all the way past the Asian close going into London. There's much cleaner examples. For example, if we use London, even if it's a day of chop and all that other madness, um, let's go from here. Now, again, the grounds that introduce rules that are just non-negotiable is you always want to see. Fuck me. You always want to see a sweep. There's no sweep, there's no trade, because if there's no sweep, some wild shit happening out there in the streets. But so, for example, here in London, right, you get this first. You get this first run down lower. Run down, clear pre-market lows. If we were doing this, say in even 15-minute windows, you'll find that there was a low there that we swept. And you see in this 15-minute time frame here, we do have a low, so we do have a 50-minute low formed here. We sweep the low, first sign, then you get this inversion fair value gap here. Just notice how once it forms, the market doesn't come back to it, and it runs past the high. The second it does that, trade is invalid, leave it alone. Now you say, cool, but here, sweep is high, and you make a bearish change in the state of delivery. And then it runs up and it say, would have stopped you out. All that's missing here is a fair value gap. Or for example, if there was no long wick on this candle here, then there would be, where's that arrow? Yeah. There wasn't such a long wick here on this candle, then you would have had a breaker formation. And I think that would have been a much better short. Then you see the market rallies up high again, clears this high. This candle here. See what it does, but only do you make a bearish change in the state of delivery kind of, although not really because there's a massive wick here. But talking about scalping here. Anyways, bias remained bullish there for a bit. So you get your inversion here. 3 o'clock runs, trades up higher. See this was once used as a propulsion block, this down close, now close past the low. So it's rejecting that level. It's rejecting that level here as well. Then you get a massive strong push. Yeah, anywho, get this big push lower. Once you take out this low again, those stops get covered. Maybe it's a case of where you say, okay, let the trade run. So it runs lower after taking out these lows. And then at that point, you're up a fairly decent amount. You've already passed the 2R point. Right? So, same thing. But if you, again, if you say looking for 3R, that would have been your 2R, get stopped. Then you get this BPR here, this model. And now, why not say, well, why not go short here when price trades up into it? Can't believe it took me so fucking long to figure this out. But I probably would have seen it more if I just watched more of the content. But it's the thing about, you know, the videos. Some days you just get lazy, or I just get lazy and I don't want to actually watch this shit. But it's counterproductive. So anyway, so why don't I take shorts here? Because although you have this bearish BPR here, or you want to call it an inversion or whatever, this low has been traded to. This low got traded to before price traded into it. So it invalidates any sells. So what does it choose to do here? If you wanted to go short here, would have taken out your stop immediately. And it runs higher, clears these highs, and then we get our, we actually get a bearish BPR here. So why would going short right here again make no sense? Because look at it, look at where your break-even point is. You're getting in short with spread and slippage. Say you got in there and your stops need to be above here, right? That is 0.3R. Not very good. So the best case scenario with these types of trades where it closes so close is maybe wait for a deep pullback, because mind you, this move only gets invalidated once this high is traded past. Although in terms of this busy termed bearish BPR or inversion fair value gap, you don't want to see those highs get close past that level, because it's the high of, it's, well, because three candles make the busy, the buy side imbalance, sell side inefficiency. So that one day you don't want to see price close past it. So when you see it really, come back up into there, if say one saw the opportunity and okay, there's also this highest up close candle, and you had opted to go short there, that 1.62R makes a lot more sense, but very, very dirty. And again, after it gets traded to, those stops need to go to break even, because look what happens afterwards. Fails to make, well, actually doesn't make a bullish BPR here. Just use this one here, that low, and so 705. So yeah, so it makes a bullish BPR. So then again, what are you looking for? You're looking for this high here. But going long at that point in time, right there and then, with that needs to be your initial target, and your stop needs to be at that low. It doesn't give you a good risk to reward. So again, you have to wait for it. Rather wait for a pullback, maybe even to the low end of the gap, which you get here. Then you get a very, very deep pullback. Blood, sweat, tears, and some rough years. So there's your position then for if you allow for a very, very deep pullback. But this is only in cases where between basically just say when it closes, you're like, cool, even if I went long, although I'm supporting this, If I were to lose two of these trades and win two of them, my risk to reward doesn't make sense. I mean, I'm not gonna explain risk to reward to myself again. So what happens again here? Bearish BPR forms. Very cool. Now you check to yourself, cool, is it an if set to high? So what are you waiting for? You're looking for this low. And you can't have price trade past that high. So when you think to yourself, it literally edges and pulls back, and it's pulling back right here, all the way. Look at how much, look at all the possible entry possibilities you had. You could have squeezed, again, them two are out of extreme consolidation, all with just waiting, not getting caught up in all these false buys and sells. So you have that, perfection plays out over here. Big strong move to the upside. What's in here? There's a small gap that kind of, or unless my eyes are failing me. Yeah, get a gap here. This candle's close should confirm it. It does confirm it. And so what are you looking for then? Looking for a pullback up into this high. This candle here offers a beautiful, delivery lower. Allows for you to get long. Another great point is because you've got a bullish breaker. That's also the low end. So if then that's the area at which you go long, stop loss is below, and that's your first target. Now you see how here this entry means that I don't have more than a 1.5 risk to reward, so you gotta wait it out. And yeah, they would have been possible, which needed a very, very deep pullback. Big push up higher. Now over here, it's one of those. If you were so committed to trading every single inversion, and you saw this one here, saw the inversion, you're like, cool, propulsion block, and you wanted this low. How often do you see the market create lows like this, sorry, highs like this, then just reverse and take out this low here? Not that often. Eh? There's usually, before a reversal, there's usually more of a sweep. There's a low form, the rally gets people long first, clears the low again, then runs. Void sells here, first high, second high, then it goes. Yes. See these types of cells, okay, it's like it just goes off quickly. Got taken out again. But again, if you're so committed to trading every single inversion fair value gap, that is between all of these trades, this will be one win here, another win here, another win here, and another one here. So that's 4 wins, right? 4 or 5 wins. Call that a profitable trade there. Now, if you really wanted to get short here, what would be the first telltale to initially decrease risk? Well, say initial stops are $11, 11 pips. After you get this one here, or maybe even just this close here, because now you're getting a bullish change in the state of delivery, because now you've traded into a busy and you've made a bullish prop block. You go from $11, 11 pips back down to 9. Not much that you're saving yourself, but say if your stop was even there because of spread, and now you're, instead of losing 12 pips, But you're taking a 12 pip hit, you're only taking an 8 pip hit. It's like a 25, 30% decrease in your loss by just sticking to it. So, I mean, where do you go again here? Yes, PPR, but this low gets traded to. So the trade is null and void. But yeah, we'll see what tomorrow brings again. That GU1, that 327.4 way up here. That's a key point, and it's a key area to be on the lookout for. And as well as the 4 hour. Oh, this would have been such a bloody good trade here on Friday. Look down into this unfold. Motherfucker. So yeah, just gotta wait. Look at find the points of liquidity on the 50-minute. Can't be every damn high and low. If you like this, when you start seeing, stop it, like a low here, a high there, low, all of these. Just zoom out, do the 1 hour. You say cool. These points here. Wait for either one of them to get taken. You know you go find a proper sell model or buy model, and that's that. Pieces of the puzzle are coming together slowly. Aye, fuck off, man. You mush cunt. You're putting your fucking phone on me.